Hi everybody, I'm Sidney McKinnon and I'm MD and CIO of Cadiz Asset Management. And welcome once again to another episode in the series of all things fixed income. I'm often asked the question as to concerning the returns within the fixed income market. How do you achieve consistent, first of all, returns, and how do you achieve risk-adjusted returns? So let me first start by looking at the first part of that question. How do you achieve consistent returns? And I think like with any investment, if you are trying to achieve consistent returns, I think what the investor is speaking about when he talks about consistent returns, he's talking about the variability of your returns. And effectively, if you're looking at an investment, and the fixed income environment has been known for giving you lower variability of returns. In other words, fluctuations of your returns or the growth within your investment portfolio will be a lot less variable than would it be in maybe another asset class. So when you're talking about a fixed income asset class that's giving you consistent returns, effectively you're talking about the variability of those returns within that asset class. Another word for it is volatility. And volatility is determined effectively by market forces. So supply and demand forces in the market, the interest rate environment, economic factors. And that will determine how volatile your portfolio is in terms of its returns. And those are the influencing factors. There's many influencing factors that will influence the way in which your portfolio's volatility will be affected. But the idea is, how do you achieve what the investor terms consistent returns? At the end of the day, what you want to do is lower that variability of returns as best and as most as you can, or best as you can. And you would do that by using certain instruments within the fixed income landscape. Your money market instruments are less volatile. They'll give you a consistent income on a month or daily basis. Whereas your capital instruments, such as your bonds, are a lot more volatile and they are a lot more prone to changes within the interest rate environment. Now, the second part of the question is, how do you get risk-adjusted returns? And let's first define what risk-adjusted returns are. Risk-adjusted returns effectively is the return that you get, or the growth that you get from your investment, after adjusting for various risk elements within that investment sphere. The most and the biggest of those risk elements is inflation. So once you are able to adjust for inflation, you can then expect a return that is adjusted. The biggest risk factor is inflation. There's other risk factors as well, such as costs and fees and perhaps the environment that you are investing in, various risk factors. But the biggest one is inflation, because if your investment does not grow, the value of your investment is going to be eroded away by the effects of inflation. So if you can remove the effects of inflation from your investment, and maybe some of the other risk factors, you will then get what is termed a risk-adjusted return. In other words, a return that is real. Another name for your risk-adjusted return is a real return. In other words, how much your investment actually grows after taking out those natural risk factors from your investment portfolio. How do you do this? I think the first way that you can actually attack risk adjusting works hand in hand with consistency of returns, and that is diversification. So when you invest in a fixed income portfolio, divide up your investments over the investment landscape or the investment range, so that you know you'll get a money market instrument that will give you consistent returns, maybe not in its isolation being able to give you inflation beating returns, but together with a capital instrument such as a bond or an inflation bond or a negotiable certificate of deposit, you're able to then reduce the effect of inflation on your portfolio. You're also able to reduce the variability of the returns. 1 month up, 1 month down, 1 month up, 1 month down will then be reduced to very small fluctuations if you constitute your portfolio correctly. I think the important thing is we all get the fear of missing out, and we often don't want to stay the course. But let me end off by saying, first of all, set yourself a goal. Where do you want to be with this investment over a period of time? How can you constitute it so that you have diversified it, so that perhaps when one asset class is not performing as well, another one will take its place. So therefore you reduce the variability of returns, and you give yourself a much better chance of getting consistent returns. And then study the course. You as an investor can also add to the risk within your portfolio if you start trading it too much or too frequently. Stay the course, know your goal, know the endpoints, and then employ those techniques which I've just discussed. So that's it for today. Until next time, I'm Sidney McKinnon from Cadiz Asset Management, and this is All Things Fixed Income.